All right, so we're looking at question 2. You've done your timeline, put everything on it, and I asked you to please do the I-entries. So from your list of credits and debits, you can't see any major intercompany loans and so on. Paragraph 1 will lead you to do your P1 at acquisition. So that means paragraph 2 tells us about our intercompany transactions. Bonnie purchased machinery with a carrying amount of 120,000 from Sunny on the 30th of June 2010. We put that onto my timeline. We found out that, oopsie daisy, 30th of June 2010, oopsie, it is here still in a prior year. We counted the months. It was 9 months and 12 months in a previous year, and then those next 12 months were in the current year, and we determined we made a profit. Okay, the carrying amount is 120, selling price is 50, so we made a profit. The residual value is 2. Remember to ignore the residual value. And we depreciate over 5 years, straight line method. So we've got an unrealized profit in a prior year. What do I debit? What do I credit? Debit retained earnings at the beginning of the year. Credit machinery, hey? And this will affect the statement of changes in equity of the group, which you're not doing, obviously, hey? But it will affect the financial position, so it does matter. Machinery affects the statement of financial position. It affects the assets. The unrealized profits are the selling price minus the carrying amount. Gave you 30. Did you get that right? There was then subsequent depreciation to eliminate in a prior year, so debit accumulated depreciation on the machinery, and credit retained earnings, last year's depreciation at the beginning of the year. This will affect your financial position, your assets. This will affect your statement of changes in equity. The calculation would be 30,000 written off over 5 years, ignoring the residual value. And because it's straight line, you can simply count the months. And you will see that 9 plus 12 give you a whole 21 months. All right, so that is 6,000 for 1 year. 9 over 12. 6 times 9 over 12 gives you 4.5 if you prefer to do it the longer way. And then 6 for the full next year. So together, that gives you 10.5. And you are more than welcome to have said 21 months. 6,000 times 21 divided by 12 will also give you 10,500. You're welcome to do the maths that way, hey? But only if it's straight line. If it's diminishing balance, you can't. We've also got depreciation for the current year. So I'm going to change to blue because it's the current year. And undepreciate the profit. If it was a loss, you would be adding depreciation, hey? So credit this year's depreciation. So what happened was you marked the goods up and you depreciated 150 instead of 120. You should have depreciated 120, so we've got to remove some of the depreciation. So worse English is undepreciate. To get rid of the depreciation on the profit. Because the profit is fake, so the depreciation on the profit is also fake. Happy with that? So, but if you'd made a loss, then you've depreciated too little, because you must depreciate the carrying amount to the group, not the marked down price. Then you need to add depreciation. So if it's a loss, you just turn the entries all around. It would be calculated the same way, yes. Just the entries will turn over. All right, depreciation would affect this year's statement of profit or loss. But we're only doing the statement of financial position, so therefore it would affect the statement of changes in equity, which we're also not doing, which means it still lands on the statement of financial position. Okay, so it'll affect your equity, essentially. The amount, you can also just show the calculation again, but you have shown once. So you don't have to show this calculation again. It's straight line method. Diminishing balance, you'd have to show the calculation. Let's make a little note here. Who made that profit? Bonnie purchased from Sunny. Sunny made the profit. Sunny is the subsidiary. So Sunny made the profit. Will NCI be affected by Sunny's transactions? Yes, because NCI's got shares in Sunny, not Bonnie. All right, and your narrations, I have put them in, even if they are not required, just so that you can get used to them. Let's see what other transactions we have. Am I finished with number 2? I think so. Nobody's bookkeeper needs to be fired, so everybody's done their job other than that. So this was pure intergroup. On the 3rd, both companies declared a dividend of 4 cents per share. At the end of the year, no dividends were declared or outstanding, so let's go and see how many shares there are. 4 million and 2 million. So Bonnie has got 4 million shares. Sunny has got 2 million shares. Each will get a dividend of 4 cents. 4 million times 4 cents gives you 160,000, and that would be 80,000 in dividends. But those are the separate companies. Remember, Bonnie has bought Sunny's shares, so some of those dividends are intercompany. But it's not an intercompany transaction, it's a P entry, do you agree? So that means we've done all 3 intercompany transactions. Not too bad, eh? All right, so that was your homework. Let's move on to the P entries. Let's do our checklist. Have we done the at acquisition entry? No. So that's our first one. Since acquisition, up to the beginning of the current year, we've done our intercompany transaction, but we need to give NCI their share of profits. Now, I don't know what the retained earnings and reval surplus is in the middle, so therefore, to give NCI their share of the current year's profits and the previous year's profits, I'm going to do one big entry. Okay, it doesn't matter if I'm taking it out of the opening retained earnings balance or the closing retained earnings balance. It's still coming out of the bottom line of retained earnings. So we're going to do those entries all as one. Give NCI their share of the change in reval surplus. Give NCI their share of the change in retained earnings. We're going to combine those entries. And the last P entry would be to give NCI their share of these dividends for the subsidiary. Okay, so I'm going to give you a couple of minutes to do P1 while I wait for the video. And then we'll check it from there and we'll do the rest together. Try P1 on your own.